Hi everyone, it's Nancy Godrad. In this session, I'm going to go over adjusting entries. Adjusting entries are needed before preparing financial statements. So depending how often the company prepares financial statements, either monthly, quarterly, and definitely once a year, adjusting entries are needed. The reason is that some of the accounts, since they were created, have changed, but we haven't had a chance to adjust them to their correct balances. We're going to go over their examples. And also we're doing this to recognize all the revenues that we have earned and expenses that we have incurred in the correct accounting period. Basically, we are complying with two rules of accounting called revenue recognition principle and expense recognition principles. Adjusting entries have a few different categories. First category we're going to go over are prepaid expenses. These are basically we paid for them during the accounting period. Once we use them, we should show them as an expense. Okay, so let's go over one of those, which is supplies. The other one is prepaid rent or prepaid advertising. Any prepaid items, prepaid insurance is another one. And then we're going to talk about the usage of equipment. And every time we use supplies, we're going to have an expense called supplies expense. If we use part of our prepaid rent, then we're going to have rent expense. If we, again, part of advertising that we prepaid is used up, we're going to have advertising expense. So in this example, when we started the period, we purchased supplies for $600, but now when we take an inventory of our supplies, basically we go and count our supplies, we only have $100 worth of supplies left. So therefore, we conclude that $500 of supplies must have been used, which is the difference between $600 and $100. Now, therefore, since the day we purchased the supplies, we debited supplies, credited either cash or accounts payable, depending on whether we paid for it right away or we put it on account. Today, we need to adjust this account, a supplies account, by showing that we have an expense, supplies expense for $500, and the supplies decreased by $500. So the remaining balance, we need to draw a line in here, is the $100 that is on hand, meaning it's left. So this is one adjusting entry, and of course we show it on the worksheet. The next adjusting entry example that I have here is for prepaid rent. At the beginning of the period, we have paid 3 months worth of rent in advance, and once 1 month of it has expires at the end of the first month, then we need to show it as rent expense by debiting rent expense and reducing prepaid rent account by the $400. So therefore, drawing a line in here, the remaining balance is $800, which is basically 2 months worth of rent that now we have available. Again, we're gonna show the expense, rent expense for $400 on the debit side for adjustments, and reduce prepaid rent by $400. So, and eventually you will see the adjusted trial balance in the worksheet showing the remaining balance or correct balances for these accounts. Now, the next item we're going to go over is property, plant, and equipment type accounts. Property, plant, and equipment type accounts are anything like equipment, building, furniture, fixture, land. The only property, plant, and equipment account that never gets depreciated, meaning we do not show the usage of it in our books, is land. And that is because, according to generally accepted accounting principle, land, the dirt itself, will not ever go away. Remember that the market value of our land and other property, plant, and equipment will change. However, we're not adjusting our books for the market value. Why? Because of a rule called cost principle. Cost principle GAAP requires that assets purchased, except for a couple of exceptions, should once we buy them, we record them at the price we paid. And if the price goes up and down because of the market, those assets will not gonna be changed to their market price, except for inventory and investments, which is beyond this class. However, we're talking about equipment. So when we purchased the equipment, the cost that we paid was $6,000. Now, we have been using it during the month, and we need to show the usage of that asset as an expense. The name of the expense is depreciation expense. Now, how do we arrive at the amount of usage? That is called depreciation, and there are different methods to arrive at depreciation. In this class, and most companies use a method called straight line method. In a straight line method, we will use two estimates. One is the useful life of the asset, and one is the residual value of the asset. Estimated useful life, and you can arrive at it by looking at regulations that IRS uses, or the management can decide based on past history how long they have used that asset. Residual value means an estimated value that we might be getting at the end of the life of the asset. Again, using estimates in accounting is okay in some instances. So straight line depreciation takes the cost minus the residual value. Residual value sometimes is called salvage value or salvage value, divided by useful life, and this useful life is in years, in our case 5 years. Therefore, every year the asset is used up or depreciated $960, but since we have only used it for 1 month so far, we're gonna show $80 as depreciation expense, and instead of crediting the asset directly, we're gonna credit a new account called accumulated depreciation. Why? Because, as I said, cost principle says you cannot reduce or increase the cost of the asset that you purchased. What type of assets? Property, plant, and equipment type assets we're talking about in this case. And so we have to create a new account to show the usage. Accumulated depreciation is that account. And so if you look at the balance sheet, you will see the computer at its original cost, and below it we always show its accumulated depreciation, which is how much of the original cost so far have been used up in the business, and the remaining amount, 6,000 minus 80 in this case, is called the book value or carrying value, meaning in our books, what is the remaining value of the assets? So again, we're gonna update the worksheet for that adjusting entry. Now, the other adjusting entries are called accrued expenses. In those type of adjusting entries, we're gonna there is an expense that has been accrued, but we haven't paid it in cash or recorded it, so we need to record it. In this example, we have an employee, John, that during the month of May has worked, and we have paid them every week except the last week of May. He has worked for 4 days and he hasn't gotten paid yet. And since he has worked, we have to show the usage of his services as an expense. And since we haven't paid him, we're going to have a payable, a liability that we need to show in our books. So we're going to debit office salaries expense and then salaries payable for the amount that we owe the employee. So previously we paid him $1,300, now another $350. So the total salaries expense would be $1,650. But since we paid $1,300 before, the salaries payable is only $350. Again, we need to update the worksheet for that and complete the worksheet. And then we use the worksheet to the adjusted, we prepare an adjusted trial balance, and then off of the adjusted trial balance, we're going to prepare the financial statements. Of course, there are other accrued expense adjusting entries, for example, for interest expense on the loan, on a borrowing. If we haven't paid for interest, we need to recognize it as interest expense and debit to interest expense and credit to interest payable. And a different category called accrued revenue. This book doesn't talk about it, but accrued revenue are revenues recognized but not yet received in cash or recorded. So the job of the accountant is to record it. An example of accrued revenue is interest receivable. In case the company has loaned money and the interest has not yet been received but earned, they need to debit interest receivable and credit interest revenue. If you have any questions about adjusting entries, please send me an email. I'll talk to you in another recording.